The portfolio's generated positive returns again over the financial year to June 30, and this continues to build on the strong performance that we've seen in recent years. Now, while we don't build the portfolios to track equity markets, what's been really fascinating to see is that over the last 3 to 5 years, the portfolios continue to keep a pace with the Australian share market. Now, these returns have been generated despite having materially higher levels of diversification and being materially lower risk than the share market. Now, whenever we're managing the portfolios to their objectives, time frame is a very relevant thing, and we continue to be very confident with the portfolios meeting their objectives over their respective 3 to 5 year time frames. But if we come back and look over the shorter term and just focus over the last 12 months, there were a number of key factors which drove returns. First of all, equity markets are positive and contributed well to portfolios. However, the first element was really what we saw as an anomalous year in 2016, where despite many, many years of losses being generated out of resource companies, they rallied very, very sharply and actually were up 42% over the calendar year of 2016. That resulted in the Australian dollar rallying slightly over the year, so that was up 3%, and that proved a slight headwind to our offshore investments, which generated underlying very strong positive returns. The final comment I wanted to make on markets was what we started to see in interest rates. The Australian 10-year bond, which started the year below 2%, which was an all-time historical low, interest rates increased quite materially and almost went through 3% over the year. Now, that's an increase in rates of about 50%, but that has really strong ramifications for the rest of the industry in terms of valuations, and it's one of the things we're focusing on quite a bit. Firstly, let me begin by setting the context of the global economy, which continues to roll along quite well. We're seeing continuing strong growth out of the US, and Europe continues to increase positively and surprise on the upside. In addition to that, some of our concerns around China haven't come to fruition, and it's done a good job to date of dealing with the imbalances in its economy and dealing with the inevitable slowing that we've been seeing there for some years. What that means for corporate earnings, which are ultimately the driver of share prices over the medium to long term, is they continue to be positive on a global basis as this positive global impact rolls through to corporate earnings. However, there are a couple of things which we're quite focused on. First, I mentioned interest rates, and what these ultra-low interest rates we've seen on a global basis in recent years have done is driven asset prices globally to quite high levels. Broadly speaking, most markets are fully valued, and in some markets, some assets are starting to become incredibly overvalued. This is coupled with a secondary thing, is we're really in a period of the market where risk is not being priced properly. So that is not only a function of the price of assets, but it's also a function of just day-to-day volatility. It's almost non-existent in the market, and whilst the global financial crisis was almost a decade ago, it seems that a number of market participants at the moment have lost sight of the nature of risk and return. What this means for portfolios is obviously with the market being more fully priced today and risk not being taken seriously, we've taken the opportunity to take some of that risk off the table. So what that means most notably is selling some of our equity holdings down, and as a result, holding much higher levels of liquidity in the portfolios. Now, we're very comfortable with that because ultimately we have a dual mandate. The first element, which we take very, very seriously, is to preserve capital. And the second component is to maximise return for the given level of risk. If equity markets or risk assets continue to perform well, we have a huge amount of confidence that the portfolios will continue to generate positive returns as a result of that, because ultimately we have a good amount of equity risk or market risk still within our portfolios. However, having taken the opportunity to take some of that risk off the table, because our concerns on market pricing and how risk is being treated, it does mean that if volatility does present itself, that we have that liquidity and we have that available capital to reallocate to new market opportunities. And we know, having done this over many, many years and cycles, that market opportunities always present themselves, and the main thing is to have the flexibility to exploit them when they present themselves. So ultimately, between those two things, both if markets continue to perform well, we'll participate, but coupled with the fact that we have almost this war chest available if market opportunities present themselves, is why we're really, really confident of meeting our portfolio objectives over the medium to long term.